It feels like we're past the inflection. Values have bottomed. We've seen transaction activity come back. We're seeing capital redeployed. So that movement feels really good. And just, I think it's always been a cyclical business, and arguably some of what happening may not be cyclical, feels a lot like it's more structural, but we feel like as we look forward that the industry is well positioned and will evolve as it always has.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. With me for today's episode is Tim Bodner, Partner, Global and Real Estate Deals Leader at PwC. Tim's with me to talk about a range of REIT-related topics, including private credit, M&A, return expectations, and more. Tim, always good to have you on the podcast.
It's great to see you, Sarah, and thanks for having us.
Tim, to start things off, how would you describe the broader mood of the commercial real estate investment environment today? And to what extent would you say macro volatility is impacting sentiment?
So the where we are today is we like to think of it as, a mood of cautious optimism with the dial creeping up. The industry has certainly, it feels, stopped asking whether the cycle has turned and started asking how fast capital re-engages. The macro volatility, things around tariffs, rates, policy uncertainty, those are, from our perspective, shaping the pace, not necessarily the direction. And some of the, the factors we look at when we make those comments is we look at, where private commercial real estate values are in terms of when they bottom. We think that happened largely in the private markets in the fourth quarter of 2024 with office kind of reaching the bottom in the second quarter of last year. So it feels like we're past the inflection. Indicators of transaction volume that we look at based on what we see in our pipelines and what we see from other market participants are somewhere in kind of the 16 to 20% range. And so the direction of travel is the same. And so on top of that, institutional investors were a net buyer of property in last year. So that feels good as well. So again, the question was kind of shifted from when does this end to how fast do we deploy, with macro volatility impacting the pace of recovery, not reversing it.
And Tim, would you say the sentiment is fairly similar to what you're seeing in the US versus global markets?
Same direction, but different speed. So the US is certainly pulling capital toward it. Global investors, based on the data we look at, raised their planned US allocation from 11 to 16% over the last year. And so even with tariffs and political noise, the US still wins on liquidity, transparency, and just the growth, the options around growth. So to take a spin around the globe briefly, in the U.S., domestic capital is leading the recovery. Insurance companies, pension, and private credits are filling the gap left by more cross-border investors. In Asia, trade policy is a much bigger concern there in terms of kind of the ranking of risk. We look at trade policy in Asia ranks 5th versus 9th globally, which is impacting Asia LPs today. The UK and India are also, from our perspective, we're seeing strong momentum in those markets in terms of where capital is intending to be deployed. Continental Europe's a little bit more two-speed, so logistics and living are quite strong from what we see. And, traditional office is still kind of working through a bit of repricing. So when you kind of look across the globe, holistically, the common thread everywhere is kind of a separation by quality and by sector. Assets that are modern, amenitized, well located are clearing. The commodity assets, is where, more where the issues are. So I guess to kind of summarize it, the recovery isn't necessarily synchronized per se, but the kind of the same general playbook is. And so everywhere we operate, what we see is kind of the winning formula is scale, sector selection, and operational depth.
Are there certain sectors that it doesn't really matter what level you're at, they're doing really well? I'm thinking probably data centers is what comes to mind.
It's really interesting. I think the areas where we see the most separation in quality is in the kind of the office and the retail sector. When we think about sectors and opportunities involving data centers and logistics and multifamily and living in general, for us, those are more location dependent versus necessarily quality dependent. Certainly quality is a consideration, But in some of these kind of newer infrastructure-like sectors, proximity to power and the like is really important. And so we're seeing that those are more impacting kind of how capital is being deployed versus just quality in and of itself.
So, Tim, can you talk about the patterns you're seeing in private credit and the impact it's having on where capital is being allocated?
Yeah, so a great question and a big topic and one that gets a lot of attention, certainly today, not just with respect to real estate and REITs, but just in general. Private credit is a topic that is top of mind for most market participants that we interact with. The way we think about it is private credit's kind of gone from an alternative to the mainstream, the addressable market based on kind of you have looked at quantifying it's about 30 trillion across asset classes. And, certainly, real estate and real assets are becoming a really important part of that. So, certainly, Sarah, there's been some stress that has been evident in the sector. There's been some bankruptcies. There's been some concern around certain sectors, particularly sectors like software, where there's a perceived likelihood of higher or greater disruption because of things like artificial intelligence. But for real estate, we kind of view as being actually in fairly good shape because the credit and the private side that's being allocated to real estate it's asset backed, it's secured by income producing property. And so it's a very different collateral, different risk profile, and different conversation. So we feel when we look at kind of the REIT's positioning with respect to private credit, it feels quite strong right now. When we look at where it's going at the moment, certainly data centers, as you mentioned, is getting a fair amount of attention, logistics, multifamily, and then other kind of digital and energy adjacent infrastructure is where we're seeing a lot of the private credit going at this point in time.
It sounds like there aren't too many huge concerns out there on the private credit side.
Yeah, I think some of the default rates that we are monitoring feels like it's kind of somewhere around 7 or 8% at the moment across the board. And lending in general certainly will have some level of defaults that will become a natural part of the overall ecosystem. But at this point, the feeling we get is that it's not like it's a systemic concern. It's more kind of cyclical and just kind of and the natural evolution of the space. And so when we look at other periods of time where we've seen a lot of distress, we certainly don't feel like that's where we are at the moment.
What would you say these trends mean in terms of deal activity and development and financing strategies going forward?
Yeah, so look, when we stare at the business today from our vantage point in our conversations with others, certainly the overall market feels good. Volumes are expected to be, up this year, as I mentioned, somewhere between 16 to 20%. We've certainly seen more platform deals come back into the equation. We feel like when we think about what the impacts of AI and technology evolution are, just other things going on that market participants are looking to grapple with, that there's a lot of catalysts in the market that provide a favorable setup for accelerated deal activity for kind of the next number of years. So the overall kind of M&A market feels very good. On the development side, I think, look, we still, across the sectors and asset classes, we still have a very significant supply issues. There just really hasn't been a lot of development activity or really any development activity in that matter outside of, for example, the data center space and to some extent senior housing. But even there, when you look at the trends in demographics, there's a forecasted shortage and multifamilies pulled back. So the opportunity, and we expect to see more development, that the constraining factors on that activity are, of course, what's happening with kind of the input costs. And so certainly we're paying close attention to what we're seeing around the macro setup, including kind of some of the geopolitical factors that are out there that could impact things like energy prices and the like. So the setup is very favorable for development. The kind of how much of it we see is, I think, dependent in part on the input cost side, as well as on how quickly zoning and other kind of approval decisions can be made. And I'm sure you all, I know, have followed this very closely, but when you look at what's happening in the housing markets, we have a very significant shortage, and a lot of the cause of that we believe is that things just aren't set up properly for market participants to act on it. So the backdrop feels good, just given there's very little supply, but we have some things to pay attention to. And then on the financing side, look, the financing markets are up significantly over last year. The banks are coming back at the margins, particularly as things like the yield curve steepens. We talked about private credit. The insurance companies are active. CMBS market's been very active. Spreads are tight and competition for deals is back. So the financing market, there's a lot of movement, which is great. The maturity wall, which is oft talked about, we kind of think about it more as like a maturity slope at this point, Sarah. So we'll continue to see a lot of extension, modifications, shorter term loans to kind of push the problem out over time. And we expect to kind of continue to see those workouts and restructuring as opposed to a wave of distressed sales. So to summarize all of it, it's really liquidity is back, but underwriting standards aren't loosening the way that they did in prior cycles.
And just hopping back to M&A, are you expecting that to be more active in certain sectors, or is it size of company? What's going to determine that?
So what's really interesting is that I think it's kind of across the board is where we expect the pace to keep accelerating. So I think for a number of years, there's been a question around when REIT M&A comes back, how many privatization transactions do we see? How many public to public transactions do we see? That's kind of been out there for a long period of time. I think where we are now, we expect that to accelerate because the setup is a bit unusual structurally. So we kind of have this persistent, NAV discount that's out there. We have a lot of dry powder, and those facts typically produce transactions. So if we just look at what we've seen over the course of 2026, the first quarter of 2026, we saw 3 REIT M&A deals, and that was the most that we saw in any quarter since the second quarter of 2023. And the total announce value through, I think it was April of this year, is about $17 billion. And there's been a number of other REITs that have already accepted takeover bids. So we expect that we're going to continue to see more of that. And the reason, Sarah, what we kind of tend to look at is, so we think there's kind of roughly 150 to 180 publicly traded equity REITs. And roughly 50% of that have market caps under $2 billion. So when you think about that size in this kind of new operating environment that we're in, there's inherent challenges of operating an investment business at that scale. And so we think that is where the M&A pipeline is. One nuance to all this that we just point out is it's not just a valuation question for us. I think what we feel at this point in time is that we're seeing boards and management teams be more willing to engage with bids than they were in the past. And that's a shift in governance that we don't see subsiding anytime soon.
And Tim, are you seeing any changes in terms of REIT and real estate return expectations at this time?
Yeah, for sure. I think when we think about, where we are today, the cost of capital if we just think about where the 10-year treasury is, it's somewhere between 4 and 4.5% today. We feel like that's the new normal. And so when we think about that higher kind of cost of capital, we think that kind of puts pressure on return expectations. Those return expectations have been rebased from our perspective. And we kind of think about returns, moving forward from here being more income driven versus cap rate compression, which is kind of where we saw, as for a long period of time, we saw a lot of cap rate compression, which was quite helpful for returns. So for us, the alpha is really in the operations, in sector selection, and in scale. And so the things that we, tend to focus on with our clients and talking about internally is we look a lot at income durability. We look a lot at operational depth. We look at what's the relative advantage associated with scale. And so that's really where we see things going from a return perspective going forward. Lower, certainly more pressure, and lower than certainly in the past, and a lot more being driven by operational discipline and execution as opposed to movement in multiples and cap rates.
And are there any new areas of real estate investment that you think could be maybe the next big thing, or at least worthy of investor attention in the next few years?
My favorite question.
Yeah.
It's my favorite question because you know
Yeah.
what? It's what we spend a lot of time talking about here at PwC among us, and then also with our clients is, it used to be that real estate was thought of as office, multifamily, logistics, hospitality, retail, etc. And what we're seeing now is really this kind of structural shift and accelerated intersection between traditional real estate and what was considered to be traditional infrastructure into this kind of this more of this real asset construct. And so certainly what we find when we say that is that many people go right to the data centers and digital infrastructure. And so from our perspective, sure, that is certainly a very significant part of the story. The trends that are happening there are incredibly strong. The forecasted capital spend is also quite significant. We just came out over the last couple of weeks with our global and U.S. infrastructure outlook, which quantifies the level of spending in this area as well as others. But for us, it's broader than just that. So we look at and we see what's happening in senior housing and the demographics, and that's in some places around the world, that's viewed as social housing, which typically has been more of an infrastructure type of strategy. And so we certainly expect there could continue to be a lot there, which we've seen. But we also see more activity happening in kind of the real assets that are supporting the reshoring and the physical economy. So think about advanced manufacturing campuses, think about cold storage. We just saw over the last few weeks $1 billion plus cold storage joint venture with a private capital market participants. That's an example of that. We look at supply chain adjacent logistics. We look at energy infrastructure led to industrial onshoring. And so it's almost like the intersection of where and what's happening with the industrial policy. Where does that meet real estate? We see a lot of momentum there. And then my favorite, what we're seeing out there in terms of activity is just incredible. And that's around sports, live entertainment, and experiential real estate. What we're seeing around stadium anchored districts, mixed use entertainment campuses, venue adjacent hospitality, the amount of capital that's going there is incredible. I think we're both here in Washington, D.C. There's a great example of that happening here in our own backyard. But it's happening all around the United States and around the world. And it's not just, when you think about the sports component, it's not just professional sports. It's also, we see a significant amount of movement at the collegiate level. And we also see a lot in the youth sports area, which is actually quite fascinating. So when we look at this overall, where things are going to go over the next 10 years, it's almost like where physical infrastructure meets demographics and what's happening digitally. The intersection of those three things is where we think the next big areas are going to attract a lot of capital investment, and we're already seeing it.
It's definitely exciting stuff to watch.
It is.
Do you see any REITs getting involved?
Absolutely. Yeah. There's a number of the net lease REITs, as an example, Sarah, that have been very, very vocal about their intentions, getting into kind of the sports, live entertainment, and experiential real estate. Will expect that their activity will accelerate from here. We're certainly seeing among the public data center REITs, the two that we have today, a lot of creativity in terms of forming various private capital funds or partnerships to get to address a lot of the development opportunity in kind of the digital area. We're seeing a number of the logistics REITs that historically have had a kind of more of a narrow focus on the types of logistics assets they've had, that we've seen them moving into not only the digital side of things, but also some of these kind of adjacent manufacturing opportunities. We, of course, have the two cold storage REITs out there. The one went public a year or so ago, and another that's been out there for a while. So for sure, when we think about the public REITs, particularly here in the U.S., we see a lot of focus on these areas.
Right. Tim, we've covered so much ground, but was there anything that we haven't touched on yet?
I think the three things that I would just lead people with, and I think I tend to go here in general when we speak, Sarah, but it continues to be our mindset that REITs and real estate market participants in general continue to demonstrate incredible resilience and creativity in navigating kind of what's put in front of them and us. Virtually all of this is outside of our control. And their ability to adapt and focus on what we can control has always been a hallmark of the industry. And so that feels really good. It also feels really good. It feels like we're past the inflection. Values have bottomed. We've seen transaction activity come back. We're seeing capital redeployed. So that movement feels really good. And just, I think it's always been a cyclical business, and arguably some of what happening may not be cyclical. It feels a lot like it's more structural, but we feel like as we look forward that the industry is well positioned and will evolve as it always has.
Very good. Tim, thank you so much.
Thank you so much for having us, Sarah. It's a pleasure.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.